Hey, so by now you've read inflation was up 7% in 2021. When you look back at history and you try to find a time period where you've experienced such inflation, you go back immediately to 1991. That was the last time we had about this amount of increase in inflation. 1991 to me seems like yesterday, but actually that was a long time ago, and about a third of the US population wasn't even born in 1991. So we have to talk a little more about what is inflation. Very simply, it's the increase in the price of goods and services, or the devaluation of your purchasing power through maybe like a lower dollar. Dollar buys less. What's causing inflation right now? A lot of people believe this inflation period is temporary. So they said, oh, by 2022, inflation will resume back to around 2%, which is the government's target, 2%. However, now people expect, and I say people, the analysts that we follow expect inflation to continue around 7% throughout the rest of this calendar year, but by 2023 subside back to around 2.25% or 2% annual inflation. It basically is being caused right now by strong demand for products. We have a lot of government stimulus. A lot of people who didn't spend money in 2020 and parts of 2021 are now looking for goods and services that are not in great supply. Not in great supply because during COVID of all the shutdowns. So we have excess money, increased wages, and we have products that just aren't available. So prices are being driven up, which is why many people think this is temporary. How do we measure inflation? The government runs a consumer price index that tracks inflation. It's a survey of households across the US and what they're spending on goods and services directly. Would not include like healthcare, where typically, yes, you pay a premium, but the insurance company is paying for the actual service. That survey, again, over the last year has shown a 7% increase, but if you remove energy and food from that calculation, it was up 5.5%. So most of us are using energy and food, so I don't know that should make us feel any better. But again, inflation is what you're spending your money on directly. So if you're not buying a truck or a car this year, then you can skip out on a 11.5% increase in inflation in car prices over the last year. However, probably you're still driving around. So gas is 50% higher than it was a year ago. Groceries, your grocery bill should be up about 6.5% across the US. However, steaks and roast beef, I noted, were up 20% over the last year. Good news for all you book readers and cheese lovers, your costs actually went down. How does inflation affect mortgages? That's a question I've gotten. With higher inflation, does that mean mortgages go up? Not necessarily. So in order to curtail inflation, the government wants to slow down spending. And they do that by simply raising interest rates. So that means that businesses would cost them more to borrow money, which could slow down the cycle of cash flow in the system. So if they raise interest rates to try to curtail inflation, we're only expected to raise a few marginal points, not even 1% this year. So I'd say for the next 12 months, mortgage rates would continue to be relatively low. Not the lowest ever, but relatively low compared to over the last 10 years. How does it affect the bond market? Obviously, bonds pay out a monthly coupon. So when that coupon gets paid out, that $100 or $1,000 you receive every single month is simply not going to buy you as much. So that's why we see the sell-off in bonds. Does that mean we need to remove all bonds from a portfolio? Absolutely not, because there's always a black swan event, something that happens, and you need those bonds to rescue the stock, because those bonds are going to look pretty good if the market has substantial declines for some reason other than just inflation and rising rates. Which leads me to the stock market. What happens with the stock market with inflation? Well, if inflation is temporary, that means that actually companies can get a boost in their earnings as they're able to justify price increases. So if that happens, the stock market's a great place to be during inflation. Now, if inflation persists going forward, that could be a problem because companies won't be able to increase their prices that fast. So that's something that we're certainly monitoring. But again, if there's concerns in the stock market because of inflation staying more longer term, the stock market is probably still the best place to be, because bonds aren't going to help you. Possibly real estate would be another opportunity, but you can't derive the liquidity and sometimes the income there that you can out of the stock market. So stock market is going to be very volatile going forward because of inflation, because of rising rates. But eventually it all kind of smooths itself out. So we kind of have to play a waiting game with stocks. Cash would be the worst place to be, because cash means you're going to lose 7% every single year if it persists. Again, our angle on this is that we're ready for a surprise stay of inflation, but our expectation currently is that the inflation will subside as the supply chain issues are fixed going forward. Thanks for watching.